Okay, so it turns out if you run a dollar store and, well, you stop charging $1, fewer people show up, but your profits absolutely explode. We are looking at Dollar Tree today, ticker DLTR, for the fourth quarter. It is March 16, 2026, and I have to say, looking at revenue hitting $5.45 billion, which is up almost 15% sequentially, it is quite a narrative shift. I mean, earnings per share jumped to $2.56, up 113% from last quarter. What is your initial rate here?
It is basically shrinkflation in reverse. You look at their 5% comparable sales growth, and it looks fantastic on paper, but it is entirely driven by a 6.3% jump in average ticket. People are visiting less. Traffic is actually down 1.2%, but they are paying $1.51 on average instead of last year's $1.34. They are masking declining frequency with, well, aggressive pricing.
Which is a really bold strategy for a core value retailer. Quick reminder, by the way, we are just two people talking into microphones, so none of this is financial advice. Please do your own homework. But yeah, breaking the buck was bold, and the market actually ended up loving it today.
Eventually, yes. The early trading was pretty chaotic. The stock had a nasty pre-market flush, dropped all the way down near $100, but once the 8 a.m. earnings call started, investors really bought into the margin story, and the stock rallied steadily, finished up about 5.24%.
Right, because the operating income basically doubled quarter over quarter. They hit a 12.7% operating margin, up from 7.2%. But the part I find completely fascinating is just how much physical friction is in this transition to their new $3 to $5 items.
You mean the manual restickering?
Exactly.
Yeah, it's not some slick software update at the register. They literally had to manually peel off and replace stickers across, I think, more than 5,000 stores. The CEO said it cost them $100 million in labor drag for the year. $30 million just in Q4 alone, which, if you think about it, is just a massive operational tax. Thousands of employees standing in aisles, peeling labels. And despite that chaos, and despite shutting down almost half their fleet for winter storms in late January, they still pulled off this beat.
It's the most analog inflation cost imaginable.
Precisely. But the real tell here is whether this expanded margin is actually sustainable. Gross margins jumped 330 basis points sequentially to 39.1%. A lot of that was lower freight costs and this new pricing mark-on, except management admitted the new tariffs are not fully flowing through their inventory yet.
Okay, yes, the classic accounting lag. The pain is coming in, about 4 months, they said?
Exactly. Plus, you have the ongoing Middle East supply chain issues kind of looming over future freight costs. So this quarter looks incredibly clean, but the underlying cost structure is, let's just say, highly unresolved.
All right, let's get into the details on that, because the mechanics under the hood here are way more interesting than the headline numbers suggest.
It really comes down to cash flow and the illusion of a clean break. Everyone is focused on the core banner right now, but if you dig into the cash flow statement, there is this massive, weirdly complex tail dragging behind them from the Family Dollar divestiture.
Wait, I thought the Family Dollar spinoff was completely done.
That is what the press release wants you to feel, but corporate divorces are never clean. They actually took a $58 million impairment this quarter. It was for a dual banner software system that they do not need anymore.
Oh, wow. So they built this custom merchandising system for both brands, and now it's just dead weight.
Exactly. Sunk cost. But that's not even the messy part. They dumped Family Dollar, sure, but they're still on the hook. Actually, they're acting as a guarantor for 120 Family Dollar store leases. It caps out around $88 million for year one post-sale.
Jeez, it's like paying alimony on commercial real estate.
That's exactly what it is. And to make it even weirder, they're actively profiting off the ghost of the old company. They logged $23 million in net benefit this quarter from a transition services agreement. Essentially, they are charging the new owners a fee to keep the back-end systems running.
So they're practically a managed IT service for the brand they just dumped.
Right. And you combine all that weirdness with their core business, and their free cash flow in Q4 alone was, well, it was staggering, almost $970 million. But there's a huge artificial bump in there, too.
An artificial bump? Like selling off real estate or something?
No, a legislative gift. It's buried in the disclosures, but they expect to defer $100 million in federal income taxes because of the, get this, the One Big Beautiful Bill Act. It was for a dual banner software system that they do not need anymore.
Oh, wow. So they built this custom merchandising system for both brands, and now it's just dead weight.
Exactly. Sunk cost. But that's not even the messy part. They dumped Family Dollar, sure, but they're still on the hook. Actually, they're acting as a guarantor for 120 Family Dollar store leases. It caps out around $88 million for year one post-sale.
Geez, it's like paying alimony on commercial real estate.
It's exactly what it is. And to make it even weirder, they're actively profiting off the ghost of the old company. They logged $23 million in net benefit this quarter from a transition services agreement. Essentially, they are charging the new owners a fee to keep the back-end systems running.
So they're practically a managed IT service for the brand they just dumped.
Right, and you combine all that weirdness with their core business, and their free cash flow in Q4 alone was, well, it was staggering, almost $970 million. But there's a huge artificial bump in there, too.
An artificial bump? Like selling off real estate or something?
No, a legislative gift. It's buried in the disclosures, but they expect to defer $100 million in federal income taxes because of the, get this, the One Big Beautiful Bill Act.
I am sorry, the what act? You cannot be serious.
OBBA, the One Big Beautiful Bill Act. It triggers immediate R&D expensing and reinstated bonus depreciation. So they get this massive one-off free cash flow tailwind that has absolutely nothing to do with selling more greeting cards.
Okay, that is wild. So the cash generation is real, but it is heavily padded by Washington and rent from their ex.
Yes, it makes the balance sheet look pristine. Which, to be fair, is what you desperately want if your core customer base is going through a massive demographic shift.
Oh, right, because we talked earlier about traffic being down. But I noticed in the transcript that their total reach is actually up. They hit a record 102 million U.S. households this quarter.
Right, which means the denominator is growing, even if the trip frequency is dropping.
Exactly. They added 6.5 million net new households. And Mike Creedon, the CEO, specifically pointed this out on the call. He said, and I am quoting here, "What we see is in the middle to higher income households, we see accelerated trade down. The price impacts everyone. For us, Dollar Tree is really that key tool that helps them."
That is a fundamental shift in the model. I mean, historically, a dollar store is countercyclical. It thrives when the lower end of the consumer base is strapped. But it seems like middle-class flight. You are seeing people making 80 or 90 grand a year trading down just to buy basic household goods.
Yeah, and maybe that is why they quietly partnered with Uber Eats recently. They're turning something like 9,000 stores into local micro-fulfillment hubs. Because if you're attracting the middle class, they're the ones who want, I don't know, party supplies delivered to their door in under an hour.
That is actually a really smart point. It bridges the gap for impulse buys without requiring a store visit, but it still leaves the core structural question. They squeezed incredible margins out of raising prices, but if the legacy customers can't afford $1.51 and the new middle-class customers are only showing up because they're squeezed, what happens when the macro pressure stops?
Or what happens if it gets worse? Because all of this feels very transitional. So where does this leave them heading into the next fiscal year?
It leaves them betting the next few quarters entirely on execution. Management is guiding for 3 to 4% comp growth in Q1, but, the real payout is supposed to hit mid-year.
Right, because they finally lap the cost of manually swapping all those physical price tags.
Exactly. The SVP, Del Rosario, basically promised that year-over-year margin expansion is going to be strongest in the second and third quarters, mostly just because that $100 million labor drag falls away.
They're actually projecting full-year earnings around $6.50 to $6.90 a share.
Which is a really confident guide, but that kind of assumes those freight and tariff headwinds don't just eat the difference, right?
That is the massive unknown here. Del Rosario even admitted on the call, I think he said it will take about 4 months as inventory cycles through before they start feeling the real impact of those tariff changes. So they have the short window of incredibly clean margins before the math gets complicated again.
It is like they are sprinting while the weather is good. But honestly, I kind of respect it. Most legacy retailers would just slowly fade out instead of completely blowing up their core identity.
Yeah, I have to give them credit. I usually hate these drawn-out restructuring stories, but they took a huge risk breaking a 40-year fixed pricing model. It was chaotic, sure, but it actually stabilized the business.
They ripped the Band-Aid off, or I guess they paid people $100 million to manually peel the stickers off.
Fair point. We will see if the new middle-class shoppers keep buying $5 party supplies on Uber Eats when the macro cycle eventually turns.
The premium party cup demographic. I love it. Well, I think that is a perfect place to wrap up our very analog dollar store journey. If you want these episodes to just show up in your feed, go ahead and follow the podcast. As a quick reminder, we use AI tools to turn hundreds of pages of financial filings into a natural conversation you can listen to on your commute. We would love to hear which ticker you want next, so drop us an email at earningsunscripted@datamadness.ca or find the X link in the show notes. Thanks for hanging out with us, and we will catch you next time.
Take care, everyone.